Thank you for tuning in to our Q4 2022 market update. My name is Brock Lassig, branch manager and leader of the Lassig team at Cross Country Mortgage. Our team believes in what we call a holistic mortgage planning approach, which inspires us to invest significant time into analyzing and understanding the market data, empowering you to make the best real estate financing decisions for you and your family. I have a favor to ask. If you find this video valuable, please like, share, and subscribe. Now let's get to it. First things first. Let's address the elephant in the room. Rates are higher than we've seen in years, and this is causing massive buyer reluctance. An interesting data point, contrary to what the news portrays, our team has actually seen an increase year over year of about 25% of qualified homebuyers in this market. With that said, we are not seeing an affordability issue as many are harping on. Instead, we're seeing buyers make a conscious choice to not buy a home despite their ability to qualify, simply waiting on mortgage rates to come down. Now, why is this so important?
This is so important because of the driving force behind every market: supply and demand. As Brock mentioned, we do not see a true affordability issue because demand is still very high. These buyers are merely sitting on the sidelines waiting for lower rates. This has caused a significant decrease in home sales, down 28% this year. This trend could last for several more months as home sales continue to lag behind real-time rate improvements. To explain, as rates improve, this will encourage sideline buyers to get back into the market. It could easily take a home buyer 30 to 60 days to find that home, and an additional 15 to 45 days to close on that. And until that home is closed, it does not reflect in this data. This will likely result in several more months of negative home sales before the data begins to improve as rates come down.
At face value, supply may appear to be elevated, but if you dig deeper, the data shows a very different story. Utah currently has about 5.5 months of inventory, but when you take out the homes that are already under contract, there's only about 2.5 months of inventory, which is equal to just 5,000 homes across the entire state. In addition, we're starting to see inventory levels drop again, with the current levels slightly in favor of sellers. In reality, the trends we're seeing are not outside of historical norms. Check out this graph of the seasonal flow of inventory in recent years. You'll notice we're right on pace with previous years. An interesting observation that our team has made is over the past 10 years, inventory has been on a steady decline. Clearly, inventory, aka supply, is still very low. And as rates start to come down, demand and sales will start to increase. We believe this increase will be a result of sideline buyers beginning to execute and new buyer demand continuing to increase. A new wave of millennial and Gen Z buyers are going to be coming to the market.
As you can see, the current fear and compression in the housing market can be isolated to almost one issue: high mortgage rates. The obvious question is, when did they come back down? As discussed in our last update, rates historically follow inflation up and down. The good news, as of early November, we are already seeing inflation come down, with most recent data missing expectations and pointing towards continual decreases in inflation. And with midterms splitting the government, inflationary spending policies will come to a halt due to political gridlock. Another important point, identified by the vertical lines in this graph, rates will also come down during a recession. This is important because many leading economic indicators are already suggesting we are in a recession or very near one of which being existing unemployment claims continuing to increase, along with major U.S. employers laying off and implementing a freeze on new hires. Influential financial market leaders raising the alarm, and the Fed is keeping their foot on the gas with economically restrictive rate increases. They even indicated that they'd be willing to push the economy into a recession and repair this by reversing course and cutting rates in the future. From a housing perspective, there is nothing to fear. As another reminder from our last market update, home prices do not typically fall during or after a recession. With all this said, mortgage rates are expected to drastically fall in 2023. Some even forecasting high fours or low fives.
Many are scared that the inflationary period we've been in the past year will cause foreclosures to rise. That isn't true. In fact, we are seeing the second lowest number of foreclosure levels since 2008, in addition to record levels of home equity. This means there are major buying opportunities in the market right now. With interest rates elevated and many buyers on the sideline, you as the buyer are the commodity, not the home. You now have more power to negotiate seller concessions and leverage loan programs that can help you save hundreds a month. You aren't aware of the opportunities that are present until they have passed. Act before the floodgates open. If you found this valuable, please share with your friends and family. Don't forget to like and subscribe, and please follow us on all platforms at Loans Elevated.